Hey, Lynn, welcome to the show. How are you doing?
Pretty good. Thanks for having me.
It's a pleasure to have you here. For the few people, I should say by now, that don't know who you are or how did you got into finance, do you want to give us a short overview?
Sure. So my background is engineering, and then I went into engineering management and running the finances for an engineering facility. But on the same time, I always had an interest in finance investing. I actually started doing that before I was an engineer. And so after a while of doing that other job, I eventually kind of transitioned back and I decided to start a research firm in 2016. And so I've been doing that ever since, and focusing on basically providing research for both retail and institutional clients. So, kind of the sweet spot that I go for is to kind of do, kind of institutional type of research, but in plain English. So it's something that it's not these like highly sophisticated structured trades, but it's also stuff that's relevant for them, but then it's explained in plain English. So the audience base is kind of from sophisticated retail up through institutional.
And your plain English doesn't even have an Italian or a Danish accent, so that's pretty good. Well done.
So let's get to it, Lynn. If we look at your current macro thesis, then I guess it is impossible not to look at supply chains globally at the moment. Alfonso and I had a quick chat about it in the intro of the podcast. We see a worsening of the situation in the port of Shanghai. So the supply chain basically keeps being distressed by various developments across the globe. How does that link to your current macro thesis?
Yes, I definitely want to avoid things that are vulnerable to the supply chain. And of course, that's somewhat impossible. I mean, it kind of spreads out to everything, but you want to avoid things that are kind of directly hurt by it. And so, prior to a couple months ago, supply chains are already disrupted. Then we throw in war into the mix, and then we also throw in, extreme lockdowns in China. And so that was kind of a one-two punch to an already stressed system. And so we have all these supply side problems in energy markets, commodity markets, and then supply, infrastructure, logistics. And so that's the supply side. Then the demand side of the macro situation is that we have, stimulus being withdrawn. So there's few countries doing fiscal anymore, and they're tightening monetary policy, and so you have kind of a softening demand, but you still have very tight supply side. And so that whole kind of inflation disinflation structure is kind of messy at the moment. And so my general position, macro view, is overall defensive, without being necessarily disinflationary.
I think that makes a ton of sense, Lynn, to position in a defensive fashion into this environment. I wanted to also talk to you about the underlying reason why we see inflation now, because I actually noted that you were one of the first commentators out there to pinpoint the move that we saw towards fiscal stimulus throughout COVID and how that basically changed the inflation picture. Can you briefly run us through why that is?
Yeah, so basically, if you look at a lot of people associate inflation with QE, right?
Yeah.
So quantitative easing. But the issue there is that, if you create bank reserves, it just stays in the banking system and the financial system doesn't really get out to the public, right? So if the Fed buys $1 trillion of bonds, my bank account doesn't get any bigger, right? So I can't go and buy more things. Whereas if they send me checks or if they give me tax cuts that are unfunded by anything, if they do various stimulus, if they give me a PPP loan and then they say, you don't have to pay it. It's make that a grant now. Well, then I can go out and buy more things, right? And so that's kind of what happened in the United States and a number of other countries where in addition to QE, so QE was it was funding some of it. It was buying some of the bonds, but there was a transmission mechanism where the fiscal authority would just give money to people, and so you had unlike say 2008, 2009, 2010, you had an increase in the balance sheet, the Federal Reserve balance sheet, but you did not have a spike in broad money supply. Whereas this time you had an actual spike in broad money supply. People had more money in their bank accounts. And I mean, that's not purely retail money, but there's a big chunk of that was retail money. And so people have more money to spend. So when you radically increase the money supply, you're prone to eventually get inflation unless you have no supply constraints anywhere. Right. And so the combination of more money units in the system and therefore more demand, combined with the fact that we've underinvested in supply chains, we've underinvested in shipping, we underinvested in many commodity, production and transporting, and so you have that combination that looks, you get it's similar to inflationary periods in the past, 2000s decade, the 1970s decade, and the 1940s decade, and specifically going back in the history books, the 1940s decade was instructive to me because that's the last time the U.S. In particular had very fiscal-driven inflation rather than, say, bank lending-driven inflation.
Yeah, it's a great summary, Lynn. And the fact that this bank deposits basically increased, especially the bank deposits not sitting in the financial system, but really retail bank deposits, if we wish, increased, while supply was also tight at the same time. It's quite an inflationary cocktail. And that's what we're seeing happening right now. But you also talked about demand now being weakening because this impulse of increased spendable bank deposits because of fiscal deficits has effectively, slowed down pretty aggressively. And bank lending is subsidizing some of it, but to a certain extent only. So how does a weakening demand interplays into your macro thesis?
So I think it takes some of the edge off the inflation trade, right? So I don't think it'll necessarily keep going up at the same rate that it was. As I previously described, in kind of my other, writings and podcasts and things like that, in the 40s and the 70s, you had disinflationary periods within overall inflationary decades. And so I wouldn't be surprised if the 2020s be the same way, where I think this is going to be a fairly inflationary decade, but that there's going to be counter trends. There's going to be periods where central banks fight back. There's going to be periods where fiscal authorities are not giving out money. And so that takes some of the edge off of the demand side and kind of transitions it from, say, a reflationary environment to a stagflationary type of environment where you still have constraints on the supply side. Some of them are even getting worse, but the demand side softer. And so I think that can manifest more so in shortages than just prices keep going up, because people just don't have the money to buy some discretionary goods. If they have to kind of prioritize the essentials, and so that's kind of relating to defensive positioning. Because if you have high inflation but you also have growth, you can go into more risk assets. Whereas if you still have supply issues, but that demand side is going down, then you want to be careful about some of the more kind of retail, consumer type of discretionary products and services.
Very interesting. So you're basically describing a pendulum, basically, where we are moving towards a structurally more inflationary decade, but there will be pendulum swings between even more inflationary trends and rather stagflationary trends where economic growth slows down. A lot of the macro discussion, Lynn, is focused on inflation. I want to get your take on real growth, potential real growth going forward. So how do you see the 2020s playing out basically from a growth perspective?
I see it as not being particularly high in inflation adjusted terms. And this next year in particular, we have declining PMI, we have very low consumer sentiment. Europe's facing an acute energy issue. China's had these extreme lockdowns. Russia's impacted by all of the sanctions, and so there are spots of growth around, right? But it's a very challenging environment overall, and while commodities and energy and things like that are scarce, it's hard to get a lot of abundant growth, right? It's kind of a pressure that kind of makes it hard to grow from. And so I think that this will be a decent decade for nominal growth, but I think a big chunk of that will be inflationary, and that real growth will be tricky to come by. Now, it's possible that by the end of the decade, if some of these release valves kind of get pushed or not, you could have kind of a mini boom. But I think that until some of those structural changes happen, I don't see this as being a very good environment for real growth.
We know that we have the midterms upcoming later this year. How important do you see the midterms for the growth outlook over the next 6-9 months?
I think so. I think because they're already kind of gridlocked, there's not really a lot happening now, and then probably not kind of happen after midterms, right? Because they'll still be gridlocked, arguably more gridlocked, at least unless polls are way off. And so um, I think some of the actions are to try to go, kind of at least tame inflation prior to the midterms, right? So, for example, drawing down the strategic petroleum reserve. I think that's somewhat of a midterm play. So I think that around the margins, it's a factor. But I think that overall, the fact that they're already basically in gridlock, that's kind of already the case. So I think that it's hard for the executive branch to unilaterally do a lot to spur growth in the next several months. And so I think that the kind of declining PMIs, the supply chain issues are going to kind of take precedent, and therefore I view it as a more defensive type of environment.
If I look at the development right now in the macro data in the US, I've actually seen quite a few positive surprises over the past month. If we look at the Atlanta now GDP measure, it bounced from roughly 0% to 2.5%, I think, in a matter of weeks. What do you make of the recent trends that we've seen in US data? Will they continue to surprise on the upside over the course of the early summer?
That's something, admittedly, I don't know. I don't have a high conviction view on that. I'm not basically calling for any sort of high conviction recession, right? So I'm not saying it's gonna keep getting worse and worse and worse. It might. I mean, it depends on what happens with supply chains and things like that. I mean, you could certainly force a recession, um, but that's kind of viewed as soft, right? So I think that we're bouncing from GDP now. If I looking at it from kind of just my mental picture, I don't have it in front of me, but it went like zero roughly, or even sub-zero, and then it bounced to something like 1.5. It kind of bouncing to a low number. It's still a low number. It's just less bad than it was, and we've kind of seen that manifested in some of the stock, right? So you kind of had a little bit of response in some risk assets. And so I'm not super bearish on risk assets. I just have a tilt towards being defensive and trying to find things that will work even in a supply side constrained environment, and then will work whether or not we have slow growth, medium growth, no growth. So kind of trying to do damage control either way.